Director of the Treasury and Mortgage Markets Directorate here at the New York Fed's Markets Desk. It's a pleasure to be joining everybody here again for our 10th annual conference. And I'm really looking forward to these events and hoping that everybody, gets into a lively set of discussions. Brian highlighted the agenda and the people that will be up here on stage, but I'd also like to acknowledge the tremendous set of attendees that we always get at this conference, which helps make for lively discussions during our breaks. And given that, I'll go over some of the logistics for the day, and then we can get started with our content. First, we'd like to remind everybody that today's conference is being live streamed to the public via webcast on the New York Fed's public website, and recordings will be posted to our website soon after the conference. I'll also note that we have members of the press here, and therefore any remarks made during the day will be considered on the record unless otherwise noted. We'll also be opening up the audience to audience Q&A at various points during the day, and we will cue people when those are happening. And when we do that, we ask that people raise their hands, and somebody will bring a mic around to you. And please introduce yourself with your name and the institution you represent before you ask your question. And we'd really like to encourage audience Q&A. However, only conference attendees will be able to ask questions, not viewers on the public webcast. Similarly, we're going to have 3 poll questions after each of the 3 panels, 1 poll question each after each of the 3 panels. And these polls will be conducted using your phones. So when we get to that time, we'll show a QR code on the screen, and that will take you to the response page. These polls are anonymous and are meant to be a way for the audience to participate in the discussion here today. In terms of other logistics, we have copies of today's agenda and a bio book of the speakers and panelists just outside the conference center where you came in. There's also a coat check just outside the door where you came in if you want to leave coats or bags there. But please make sure you get everything before heading down to the reception, which will be down on the first floor. And speaking of first floor, both the luncheon and the reception will be in the Liberty Room dining room on the first floor where you first checked in this morning. And we have 2 scheduled breaks that will be just right outside of the auditorium here. Also, there are conference support staff here to help if you have any other questions. And you can see people with the special staff badges here. Probably not speaker badges. They wouldn't be as helpful. So without any further ado, it's my pleasure to kick off the conference with pre-recorded remarks from FOMC Chair Powell. Jerome Powell first took office as the chair of the Board of Governors of the Federal Reserve System in 2018. In that role, Mr. Powell also serves as the chair of the Federal Open Market Committee. Mr. Powell has served as a member of the Federal Reserve Board of Governors since 2012. And prior to his work at the Federal Reserve, Mr. Powell has held a number of roles in public and private sectors, including Undersecretary for Domestic Finance at the Treasury. I ask you now to turn your attention to this video from Chair Powell.
Hello, everyone, and welcome to the 10th Annual U.S. Treasury Market Conference. 10th Annual is a phrase that generates a bit of surprise and much pride. It is surprising because it does not seem like the first of these gatherings, which I was honored to play a role in organizing, was all that long ago. But we can also take pride because the conference has proven useful and important for a full decade, as I expect it will do for many more years to come. Much has changed in the economy since we first gathered in 2015, but the importance of the U.S. Treasury market has not. As you all know, this market is the deepest and most liquid in the world. In addition to meeting the financing needs of the federal government, it plays a critical role in the implementation of monetary policy. It is no exaggeration to say that the Treasury market is part of the bedrock of our economy and indeed of the world economy. The October 14 flash crash and the subsequent publication of the Interagency Working Group report on that event are what brought us together for the first annual conference October 2014 was a wake-up call because there had never been such a large swing in Treasury prices in such a short period of time. The Interagency Working Group report shed light on how much the structure of the Treasury market had changed and how large a role high-speed electronic trading firms were playing in it. It also showed the value of cooperation and communication between the 5 agencies in the working group, something that proved again to be vital during the disruptions caused by the COVID-19 pandemic. I'm pleased to see that all working group members are represented here today. You will be hearing directly from many senior leaders, including your host, President Williams, Vice Chair Barr, and Secretary Yellen, who of course was Fed Chair at the time of the first conference. It is essential that our Treasury markets are able to efficiently transform Treasury securities into cash, even at times of elevated stress. As I noted at this event in 2015, these markets need to keep functioning at a high level, and we all have a stake in making sure that they do. I remained wholly dedicated to that goal. I wish you a productive and educational conference. Thank you.
Thank you to Chair Powell for those remarks. It's now my pleasure to introduce John Williams. He's the President and CEO of the Federal Reserve Bank of New York, a position he's held since 2018. And as part of that role, he also serves as Vice Chair and permanent voting member of the FOMC. Before joining the New York Fed, he was President and CEO of the San Francisco Fed since 2011, and prior to that, their research director. President Williams began his career as an economist at the Federal Reserve's Board of Governors. He also serves as a senior economist in the White House Council of Economic Advisors and a lecturer at Stanford. So please join me in welcoming President Williams.
Well, welcome everyone, and thank you for joining us today. And a special thank you to all those who make today's event so powerful, the distinguished speakers, the panelists, and the event organizers. So we have a packed agenda, and I'm excited to see what's to come on a variety of important topics. I look forward to hearing about the progress that we've made and some of the priorities we have for the future. So, as we heard from Chair Powell, today marks our 10th annual U.S. Treasury Market Conference. I think I may be the 4th person who said that. I'm guessing I won't be the last. It represents a decade of partnership between our agencies. These conferences have proven to be a valuable forum to share insights and perspectives on the evolution of the Treasury market, identify challenges and risks to smooth market functioning, and most importantly, discuss ways to enhance its resilience and effectiveness in both good times and bad times. The New York Fed is proud to host the conference each year. It leverages, well, I realize that leverage is actually not a good word for this crowd. So shall I say it draws upon our strength as a convener of market participants, academics, policymakers, and central bankers. Today I'll take a look at how our interagency collaboration has strengthened our understanding of Treasury market resiliency and that of adjacent markets. And I'll talk about the importance of continuing this work over the next decade and beyond. I'll also share some news about our ongoing commitment to ensuring that our financial system continues to stand on a strong foundation of sound reference rates. I got to give the standard Fed disclaimer. The views I express are my own and do not necessarily reflect the views of the Federal Open Market Committee or anyone else in the Federal Reserve System. So let's think back to the middle of October 2014, when U.S. Treasury yields plunged and then quickly rebounded, an episode later named the Flash Rally. This episode was an impetus for the drafting of the Joint Staff Report that ultimately led to the inaugural U.S. Treasury Market Conference in 2015. That conference first brought together what is now known as the Joint Member Agencies to discuss the evolving structure of the Treasury market. Going back in time, that meeting focused on the potential operational risks, the regulatory requirements, and considerations around repo markets. It drew about 300 people in our first conference. That's an impressive figure for our first year. And I know that some of you who participated in that conference are here again today. The organizers recognized that it would be important to have a regular forum to address developments in the Treasury market and the adjacent markets in order to continue to study structural issues and explore ongoing developments as a way to prevent disruptions in the system. Now, to be clear, attention on the function of the Treasury market didn't start in 2015. In fact, if you read Fed history, this is one of my favorite activities, it's clear that the importance of Treasury market functioning has been central to the Federal Reserve and here at the New York Fed for a very long time. But what became apparent in more recent times was that as the markets evolved, the need for formal joint agency collaboration and engagement with the private sector became more pressing. So what drives all of our efforts, from the staff reports to the conferences to actions and all the communications in between, is that liquid and well-functioning markets for Treasury and related securities are absolutely essential for credit to flow and the economy to prosper. It's not an overstatement that a well-functioning U.S. Treasury market is critical to our economy and, in fact, to the entire world. So what are some of the themes we've discussed at these conferences, and what's been the impact on our financial system? So if you look back at the original joint staff report, it really highlighted two notable issues. First, that principal trading firms played a much larger role in the electronic trading market than was previously understood. And second, the need for improved transparency and increased availability of Treasury market data. 10 years gone, the song remains the same. Those themes are still at the forefront of our conversations. For example, while principal trading firms still continue to be a big presence in the market, hedge funds now play an increasingly important role. And the work monitoring the changing investor base and participant types continues through this forum, and the work of the Interagency Working Group on Treasury Market Surveillance and the Financial Stability Oversight Council. And I don't know if you're noticing, I have not used an acronym yet. We'll see. I think there's some coming. Okay. On the data side, we've made tremendous progress towards increased data transparency with the Trade Reporting and Compliance Engine Data Initiative, commonly called TRACE. And while we've seen efforts to further increase the transparency, of this data to the public, March of this year, TRACE began publishing daily transaction data on the on-the-run securities at the end of each day. In fact, at this very podium last year, I said that we must continue to prioritize transparency and clarity in financial data, especially we look ahead to the age of AI, where the sources of data will be harder and harder to ascertain. I'd be remiss if I did not mention expanded central clearing as another key theme that's emerged over the years. It's a major shift. There's an outgrowth of our work, and we'll hear more about that in a panel discussion later today. And I look forward to the continued progress the market will make on this front as we move toward the implementation deadlines of the SEC's clearing rule. Okay, so before I cede the stage, I'll end on a topic that's at the core of the financial system, very closely connected to the Treasury market, and that's reference rates. Thankfully, we've said good riddance to LIBOR, and our financial system is now resting on a safe and solid foundation. Now, I know for those who were here last year that I promised I would not mention LIBOR ever again in this forum. Okay, but the LIBOR saga taught us all two important lessons. First, enormous systemic risk can build in the global financial system gradually over time. And second, it took a complex, expensive, decade-long effort to fix that problem. And we must not repeat that experience. So to that end, I'm pleased to announce that today, the Federal Reserve Bank of New York is launching the Reference Rate Use Committee. It will convene private market participants to support the integrity, efficiency, and resiliency in the use of interest rate benchmarks or reference rates across financial markets. And that includes the rates published here at the New York Fed. Its first meeting will occur next month in October. The committee will focus on key issues regarding reference rates, including how their use is evolving and how the markets underpinning them change over time. It will promote best practices related to the use of reference rates, including the recommendations set out by the Alternative Reference Rates Committee, or ARC, during the transition away from LIBOR. In this way, it will serve as an essential partnership that builds upon the work and accomplishments of the ARC by helping to preserve a robust system of reference rates. This will complement international efforts at the Bank for International Settlements and the Financial Stability Board to monitor developments in the use of interest rate benchmarks and ensure that we never again have to face a problem like LIBOR. So I'll bring it on home. We're now on the bridge to the next 10 years of the U.S. Treasury Market Conference. Although there's been significant progress, the growth and evolution of this market remind us of the importance of staying focused on this work and continuing to make progress in the years ahead. In an era of heightened uncertainty and volatility, it's essential that the U.S. Treasury market remain liquid and resilient so that all financial markets can operate effectively. If you are ever in doubt how important this work is, the experience of the past several years should convince you otherwise. Thank you, and I look forward to today's conference and to another decade of partnership and success.
Thank you, President Williams, for those remarks. This time we're going to jump into our first panel, which will focus on the use of Treasury futures by asset managers. We'll reserve some time at the end of this panel for Q&A from the audience, so you can get your questions ready. I'll be handing the discussion over to Scott Mixon, who will be moderating the panel. Dr. Mixon is the acting chief economist at the CFTC. His work focuses on economic and econometric analysis of derivatives markets, as well as directing research activities of the Commission in connection with rulemaking and policy. Prior to joining the CFTC, Dr. Mixon spent more than 15 years in the private sector. So please join me in welcoming Scott Mixon and the panelists.
We have the slide. The slide. Okay. The basis trade. That's sort of the catch-all term. It's become over the last several years. People use that to describe just the general patterns of futures and cash market activity and treasuries that they've seen, and the role of hedge funds in arbitraging the Treasury cash futures basis, or the basis trade, has been widely discussed, including at last year's conference. And at last year's conference, there was no single panel on the basis trade, but it went through every panel, and it was in the speaker's remarks. And at the time, not a lot of attention had been paid to the underlying factors, or we hadn't figured out some of the underlying factors that cause those patterns to exist. Now, what the world has seen really refers to the data behind me on the screen every week, and that's the CFTC's Commitments of Traders report. It's published every Friday afternoon, and it shows that asset managers, this broad group, has been persistently net long over the past few years, and hence they've been this demand for long Treasury futures exposure. And leveraged funds, if you look at the report, have offset this with their short exposure. They've been basically the mirror image of the asset managers. Now, this panel is designed to go beyond these headlines and focus on the asset managers, the long side. So the goal is to understand the factors influencing their choices among the different Treasury instruments and related instruments that are available to them. So cash instruments, repo, futures. We'll also let them talk about other derivatives. We'll let them talk about interest rate swaps or total return swaps, forwards in the context. And they'll specifically talk about some of the regulatory, accounting, and market factors that influence the different types of asset managers in their portfolios. So to do this, we've assembled this outstanding group of thought leaders and practitioners, and they have a range of perspectives in the asset management space. So I'll introduce to you, to my left, I have Joe Demetric, Senior Vice President within MetLife Insurance Investments. MetLife Insurance Investments provides the insurer investment function for MetLife's general account. And Joe is the head of derivatives trading and brings over 30 years of experience in the financial markets to this role. To his left, David Eichhorn. David is Chief Executive Officer and Head of Investment Strategies at NISA Investment Advisors. He's also Chairman of the Investment Committee and a member of the Management Committee there. NISA Investment Advisors focuses on large institutional clients and is the largest U.S. manager of LDI strategies. We have David Rogel next in line. He's head of total return and inflation portfolios at BlackRock. He's managing director and portfolio manager in BlackRock's fundamental fixed income group, member of the FFI Executive Committee. He is a member of the Treasury Borrowing Advisory Committee. And farthest on the left, my left, is Greg Peters. Greg is the co-chief investment officer of PGIM Fixed Income and a co-head of the firm's multi-sector team. We may have joining us in a few minutes Mohit Mittal, who will join us at the end. He is the chief investment officer, core strategies, and a managing director at PIMCO. He's a member of the investment committee there and a portfolio manager for a range of fixed income portfolios. And he is the vice chair of the Treasury Borrowing Advisory Committee. So let's begin. David Rogel, The Treasury Borrowing Advisory Committee, TBAC, meets quarterly with the Treasury Department, has representatives from buy side, sell side, and when they convened this past January, there was a presentation responding to the charge to examine the drivers of investor preferences for futures, cash, instruments like that. So you're a member of the TBAC. Could you start off the conversation, refresh us on that presentation? I think it sort of changed the discussion a little bit. Can you tell us the key discussion and findings?
Sure. And thank you, Scott. And it's great to be here. And it's a privilege to present TBAC's work on this topic. So looking forward to it. I would also echo some of Scott's comments that the way Treasury posed the question and the work that came out of this, I think, helped to paint a fuller picture of the conversation around the investor landscape and Treasury futures. A lot of discussion on the basis trade, less discussion on why it exists and who takes the other side. And I'll start by reviewing the conclusions of the work at a high level, which is that the committee found that asset managers do have a structural preference to own Treasury futures. And this is really driven by asset allocation needs and a switch out of Treasuries into credit, being overweight credit to enhance yield versus benchmarks. This creates a structural demand and a structural richness in Treasury futures that then hedge funds can take advantage of in leveraged relative value and basis trading strategies. So that's a high-level conclusion. We look through the CFTC data to start in the presentation, and what we find is that we've seen a very large open interest increase in Treasury futures over time, and that's really grown with the overall size of the Treasury market. But importantly, if you look at the size relative to the Treasury market, it has increased recently to around 15% of open interest, around 15% of the Treasury market ex SOMA. So you have seen a modest re-leveraging. And also echoing Scott's comments, if you look at the investor breakdown, there's been this persistent rise in asset manager exposure to reach recently over $1 trillion in notional terms. Simultaneously, there's been an increase in the leverage fund short position to over $1 trillion, and the two are almost the mirror image of one another. So why is that the case? So digging into the next part of the conversation, I'll focus really on the asset manager portion of the charge. And the first question that's asked is, why do asset managers use Treasury futures? And is it possible that active duration and curve positioning is responsible for the changes in asset manager exposures? And the short conclusion is that it really can't explain the structural rise that we've seen. The committee looked at an empirical duration analysis of 20 large asset managers and found that even during periods where managers were trading short their benchmarks, you still had this positive net futures position. And it did seem to correlate somewhat with shorter term fluctuations, but it couldn't really explain the overall trend. The presentation also discussed in more detail why asset managers would prefer futures over repo and treasuries. And there are really four reasons that were cited. The first is operational simplicity. So futures offer an amount of operational simplicity, especially across many accounts, that you can't get with repo. Second, there's large portions of the industry, for example, institutional separate accounts, where guidelines or investment management agreements don't allow repo. Third, the regulatory structure around 40 Act funds for a while made it easier to use futures from a leverage standpoint. And lastly, there's a FINRA rule that requires 40 Act funds to report interest expense from repos into their operating expenses in prospectuses. And in 2018, Morningstar made a change to the reported expense ratios, including interest expense. And so what this created was a communication challenge for some managers that were using repo relative to managers that were using futures, because suddenly they looked more expensive, even though in practice, economically, it was either equivalent or cheaper to use repo. So those are really many of the reasons why we see this gravitation towards futures in the asset manager community. And next, the question really comes back to why is there this structural long position in futures? And it's important to look at the category. So if you look at the largest retail fixed income category, it's intermediate core and core plus. And most of these, it's over $2 trillion category, and most of these managers are benchmarked to the Bloomberg Ag Index. And over the last 20 years, we've seen the Ag Index go from a 20% treasury weight to around a 45% treasury weight, very concentrated as a result of treasury issuance. And so a couple things are happening. Managers are choosing to own a more diversified portfolio. of credit and other assets. And they're also allocating out of treasuries into credit in order to enhance yield. And so if you think about it from a very simple level, managers are selling treasuries to buy corporates or other spread product and buying back the treasury exposure through futures. The simplest example of this is if you buy a floating rate asset, you sell a fixed rate treasury, you buy a floating rate asset, you lose duration, you have to get your duration back in futures. Alternatively, you could have repoed your treasury book to generate that cash, but that would have generated complexity and expense associated with that. So that's the main thrust of it. Just two more quick things. To try to validate that hypothesis, the committee looked at 14 large asset management platforms and looked at the AUM-weighted average credit exposure. And what we found was that there has been a significant increase in credit overweights in recent years. And that increase did tend to correlate somewhat with the net futures position. So it supports the idea that this credit demand is driving the demand for treasury futures. Lastly, there was some work done on estimating the cost, because we know there's a cost to doing this trade. And what we found is that when you compare the performance of the Treasury cash index against a replication strategy with Treasury futures, in the last 6 years, that's cost around 40 to 45 basis points per year to implement in futures relative to cash. And that sounded like a big number. If you look at CTD basis implied repo, you're talking about more like 10 to 15 basis points. But a lot of other factors at work here, including the richness and the deliverable in the futures contract. For example, if you replicate the Treasury index with on the runs, you'll see over the roll cycle, those on the runs will cheapen over time, and you'd see a similar cost with that type of replication. But importantly, what we found as well is that the average credit spread available in various markets easily hurdled that cost. So it still made economic sense for asset managers to pay that financing cost to go into higher yielding assets. I'll leave it there, but the rest of the presentation really focused on the leverage fund side, which we won't really address, but conclusions there were really that this increase in exposure on leverage funds was really coming from leveraged relative value strategies. There's a bunch of work done by the Federal Reserve to support that, and that this ecosystem has developed where hedge funds are implementing the basis trade or RV trades, and asset managers are on the other side of it.
Wow, thank you for that. That was a very thorough report that the committee did. I think there's a lot to unpack there. We have many panels that we could work from. Let's start, Greg, from PGIM's perspective, from your perspective, some of these dynamics and cross-sectional aspects that David just described from the committee, what resonates with you? So for example, like the repo issues and futures and those things, what stands out to you as having resonance?
No, so I think David's comment's spot on, and quite frankly, this is something I talked about last year, so I sound like a broken record, but I think it's an important topic. On the asset management side, I think it's important to think about how we manage our risks, right? You have, and this is called 3 separate buckets. In one bucket, you have spread risk, you have duration risk, and then let's say you have FX risk. And so you think about those independently. And when you do that, invariably, when spreads are at levels where they typically are, you as an asset manager are benefiting from buying an asset and using a future. So let's just kind of use a stylized, simple example. So I will happily go out and use my cash to buy, let's say, a AAA CLO at SOFR plus 150. I know the drag of using that future is just called 40 basis points to get my duration to where I want it to be. Because once again, I'm separating out those risks. So I'm earning a net positive spread of 110 basis points. So from an asset management standpoint, it's about the relative value opportunity around treasuries, right? It just so happens that treasuries don't offer a lot of relative value opportunities. So we're just doing what we think is best as a fiduciary. That's the first thing. I think that is the most critical. And the second is absolutely right. The structural frictions in the system around repo using treasuries are not going away. And that expense issue is a really important issue. What I know, you're supposed to be indifferent, but you're not, right? Or more importantly, the folks who sell those funds are not. And so that expense ratio is what is really quite meaningful. But even the dealer community treats repo very different than they do futures. So if you open up a new account, as an example, get an ISDA or one of the various stocks that you have to file, there's not even a batting of the eye if they ask, oh, do you use futures? No one cares. But if they say, or if they ask, do you use repo? Well, that changes the whole dynamic. That changes the whole cost function that you get from the dealer side. So there's a structural issue there. One is the relative value, which is seemingly persistent, and the other persistent issue is just a structural bias against using repo and thus treasuries.
Thank you. Let's keep setting up the landscape, and let's move to you, Joe. So you're at an insurance company. So when you hear these comments, what's similar for you? What's different for you from your insurance perspective?
Right. So life insurers, we're offering products out to our customers that have very long durations. They go 10, 20, 30 years plus. So when we're constructing asset allocations to back those liabilities, we're looking to achieve a portfolio that has the basic same cash flow dynamics, same interest rate dynamics as that liability. That's our benchmark, right? We're not benchmarked against the ag. We're looking to outperform that liability. So when we're doing that, we're going to incorporate spread assets, much like other asset managers, into that asset allocation. And a lot of those will either be shorter duration or more intermediate duration. So it makes it challenging to come up with an effective asset allocation match, right, because of that. And what a lot of life insurers will do is they'll look at the derivatives markets to try to close those gaps and have that match with their liabilities. Now, when we do that, we're going to look at the full range of different hedging instruments that are available to us. We're going to look at interest rate swaps, treasury futures, and also treasury combined with repo, right? That can either be done explicitly, or we could do it in a OTC derivative contract, something like a treasury bond forward or a treasury TR total return swap, where we're effectively capturing those same economics, but we're doing that in a derivatives form. And when we're looking at these different instruments and trying to say, okay, well, what is the best thing? We're going to look at that through some different lenses. That's going to be hedge effectiveness, what the costs are, and the financial statement impacts. So from a hedge effectiveness standpoint, does this instrument match what I'm trying to hedge? Is there basis? And importantly, is there volatility potentially in the basis that may make it a less effective hedge for us? We'll look at costs holistically. So that's going to be things like what's the implied repo or the implied funding costs. But not only that, but what are the liquidity costs associated with different instruments? And also, what are the margin costs? Different derivative instruments have different margin requirements, different types of collateral, whether it's all cash in a cleared instrument versus an OTC derivative where I could use potentially a lot of non-cash bonds off of our portfolio under the uncleared margin rules. So that may be a consideration for people. And the last piece would be financial statement impacts. So for us, our liabilities are largely held at amortized cost. If we're able to achieve hedge accounting on different derivative strategies, then the economics and the accounting more align on our balance sheet. So I would say that's also one area that's maybe on balance a little bit more important for a life insurer than, say, somebody who's operating in a total return framework or total mark-to-market. So I think what we've been seeing as far as trends in the broader life insurance industry is a lot more use of treasury-based OTC derivative product. There's a few reasons for that. One, from the effectiveness standpoint, or just from a cost, we see lower costs there than, say, using other products like futures or swaps. And also the fact that you can customize those positions. So with a treasury bond forward, we can isolate certain points of the curve that we want exposure to. We can also adjust the front tenor of when we're going to do that. And that may, it better aligns with our liabilities. And also it allows us to lock in hedging costs over longer periods of time, which if you're doing a rolling strategy, there's going to be some volatility to that. And then the last piece, as far as just on the financial statement, impacts. For something like a forward, there are more clear pathways to achieving hedge accounting. You can certainly achieve that using the other instruments, but it can be certainly much more challenging. Now, that being said, we do have other products, right? We have shorter duration products, and we have products that have embedded optionality. And some of those, like variable annuities, they can require more dynamic hedging, where we have to go in and adjust the hedges on a much more frequent basis. So when we're looking at strategies and how to hedge those types of products, things like liquidity costs become more of a consideration, right? So for those, you would tend to see futures be a larger part of the hedging program, where liquidity costs might weigh some of those other considerations. So for us, it's very dynamic. We will continually look across the landscape and adjust as far as put on different derivatives as appropriate for those.
So did I hear you say at the end, more active is more futures? Is that fair?
I think for certain products, what you will see is more futures usage for those types of products.
Okay. And then to clarify, you mentioned before treasury-based OTC instruments. So you were thinking instruments, which instruments?
I think specifically we've seen a lot more in treasury bond forwards. So that's an agreement where you enter into under an ISDA with a dealer, you agree to buy a specific treasury at a specific point in time. Now that doesn't need to be, that could be an arbitrary period. Right? That could be a year out, 2 years out, potentially 3 years out. So when you do that, what you're doing is you're locking in what are the funding costs associated with that position.
Okay. David, let's continue setting up that landscape. So NISA advises and manages money on behalf of a number of pension funds, I understand. So do these pension funds, do they have different constraints than what you've heard, or is it similar constraints? Are they freer or more constrained to move along these markets? How does that affect your work?
Well, Joe did a great job. I mean, pension funds are very similar to at least a lot of the liabilities in the insurance framework. So I'll maybe circle back to that in a second. I will comment. We're a large active manager against benchmarks, the aggregate, I was about to say Lehman, Barclays, Bloomberg, aggregate index, long gov credit, et cetera. So we are not one of the ones who tend to use futures in those engagements as a way to get long credit. And there's kind of two main reasons for that. A key element of that is just philosophical. We think just being long credit isn't true alpha. You can just get that by buying a credit ETF. You shouldn't pay us active fees for it. And the second part is the cost identified. Yeah, when you ultimately have to fade 40, 45 basis points of cost in the futures market, and you're getting something that has 100 or 150 over spread, your net's still ahead, but you're giving far too much of that risk premium back. And so we don't use them that way or in any real degree. Where we do is coming back to our pension clients. So we are the largest manager of LDI clients in the US. We may circle back around. I know the UK LDI experience. I never expected LDI to be in that acronym to ever be in the New York Times, and suddenly we were very popular and got a lot of phone calls from people I've never met. But we are the largest manager in the US, and importantly, what that means is for decades now, given how clients allocate their money within their pensions, there's usually a demand for duration that their physical bonds cannot satisfy. So we're a very, very large manager of US Treasury strips. So those, of course, are not derivatives, a fabulous way to get a lot of duration, but you still need cash. They're capital efficient. But at some point, if I'll say at this point, maybe the prototypical pension is 40% in risk assets, 50, 60%, say, in fixed income assets. If they're trying to mitigate the interest rate risk in their liability, which is enormous, it's very similar to the interest rate risk that Joe is describing, at least in maybe your annuity book. If they're trying to mitigate most or all of that, they need to get additional duration somehow. So these liabilities tend to be 14, 15, 16 years in duration. There's a desire for some amount of risk assets on a portion of their portfolio. So the role we play, and other managers similar to us, is we take a portion of their fixed income assets and add some degree of interest rate derivatives. Futures are clearly a great liquid alternative, but we really use the triumvirate that Joe alluded to. Certainly, repo has increasingly become a large part of our book of business, and total return swaps, either on individual Treasury securities or indices of Treasury securities. So at any point in time, NISA has had, let's just say on average, we've had 100 to 150 billion of notional exposure in some rate market, the vast majority of which is to mitigate a risk, mitigate that pension risk. And that's, I know the term leverage was joked about early in the opening comments. You could describe that as leverage, but there's no monolithic definition, frankly, of leverage. And so when you look at a pension fund is inherently, when it's fully funded, is inherently levered, right? You owe $1 to pension beneficiaries that you promised, and you're long $1 of assets. So what really the role of derivative is to de-lever the economic risk of that pension. So that word can be used in a lot of ways. Sometimes it's demonized, or demonizes usage. As I always describe derivatives like glue. They have good applications like adhesion, and they have very bad applications like sniffing it, right? And we've seen both of those applications in the derivative market, at least in my career. But certainly the pension usage, when scaled prudently and sufficient collateral, which we've seen in the case of the U.S. for a long time now, we think is a very, very prudent use of derivatives.
Mohit, welcome. We started off with an overview of the TBAC presentation, which covered a lot of different topics. And we followed up on some of the issues that came out there. So you had seen that presentation, you're aware of it. Were there pieces that had the most resonance for you, or pieces where you had a different experience?
Yeah, certainly. I think there are lots of pieces that had really good resonance. I think firstly, as at PIMCO, as almost managing 2 trillion, we are involved across strategies. So a lot of it in LDI, short duration, intermediate, ag oriented. So similar to my other colleagues involved across strategies. In David's presentation, I think he summarized beautifully the reasons why asset managers tend to have some form of, call it notional leverage, even though it's not real leverage, which included kind of targeted duration management, yield curve positioning, as well as active views. And then the question, which David covered well as well, was the comparison between the usage of derivatives or futures versus usage of repo, and the reasons that were cited. Again, I would agree with some of the reasons with respect to repo limits in accounts, SMA guidelines which prevent the usage of repo, and, a simplification of execution as we have to execute across large number of SMA. Having some proportion in futures allows us to implement it a little more seamlessly than having large number of individual CUSIPs across large number of SMAs. Even the discussion around interest expense plays a role as far as mutual funds is concerned. But I think one other area that is quite notable for us is the liquidity considerations. I think if we have to change views, or when we change views and we have to execute in size, having futures allows us to implement that in a little more anonymous manner relative to kind of having treasuries and then having to go to a broker dealer and having to seek liquidity that way. So liquidity and anonymity plays a role. I think on that same vein, what could be kind of a way to offset would be having an ability to do all to all. Right now, we have, if you have to execute across a treasury, you have to go to a broker dealer. But there's no kind of a real large all-to-all platform that would kind of enable us to use treasuries little more than futures at the margin. Even the platforms to access the Fed or even the treasury buyback involve going through a broker dealer. Again, that would be something that would enable asset managers to directly access the Fed as well as the treasury buyback operations, could at the margin increase the usage of treasury relative to futures. And then last but not the least, I think what David also had in his presentation was the numbers that he had. He basically highlighted at the asset manager level, the leverage is to the tune of about 20% in futures, but at the levered fund level or the hedge fund level, it's 20x. And I think that is a very, very important thing to focus on. And why that is important is that a 20% leverage essentially means that if that quote unquote basis trade moves, say, for example, 5 basis points times duration, call it 50 cents, give or take, that means that an asset manager has minus 10 bips of alpha, which is very, very manageable in the context of return objectives, in the context of alpha objectives, and does not trigger any, call it position change because of that position going against. Whereas if on the other side, on the levered community side, at a 20x leverage, if that position goes 50 basis points against you in an unlevered manner, that means it's a 10 percentage point decline, and that triggers a lot of action unwind. So that's why it is important to kind of, while it is, for 700-800 billion notional of long at the asset manager side, there is a 700 billion notional on the short on the other side. The magnitude of leverage being so much different is quite important.
Thank you. So I'll offer this out to the group. Some of the points that you folks have mentioned involve, say, futures versus repo, which are similar in some respects in terms of the effect on the portfolio potentially. You've mentioned some of the regulatory and accounting differences that exist, and you also mentioned some of the issues like a number of managed accounts perhaps not allowing repo, whereas they might allow futures. So if you had a magic wand and some of those frictions, regulatory differences might be changed, what changes in your day-to-day? Do you still face those frictions? Are things different?
I think you have to clarify the regulatory scheme. So there's a lot of focus on SLR. That's one piece of it, of course. But there's just so much friction in such a variety of different ways that make repo more challenged. And so I know there's a lot of focus on the basis trade. The question I always ask myself is, so if that didn't exist, what would be the case, right? And what that would be is that Treasuries would be that much higher, which I don't think is the intent of the U.S. Treasury or what is good for the country, so to speak. So I think we need to kind of work through the various clearing rules, the IMA rules for repo and all these accounts. Like we have to create a sense of indifference, and there's anything but indifference. There's just a predilection for managers, for ease, for everything that's been discussed to use a future, and in most circles, futures are not considered leverage, rightly or wrongly, but repo is. And so that's a stigma and something that I think needs to change through some sort of regulatory coordination and change of construct.
And maybe I'd add to that, most of our clients live in we don't have 40 Act mutual funds. Our clients are largely pension plans, a lot of which are corporate pension plans. So there's no regulatory limit on using futures versus TRS versus futures. Clearly, there's always simpler is better when it works. But over time, for a host of reasons, but the basis being a huge part of it, and this is why I kind of love how markets work in efficient markets, is that basis got larger and larger. It was more and more expensive, obviously, to us to keep that hedge in place. It was still worth it. They were hedging an enormous amount of interest rate risk. So if you have to fade 30 or 40 basis points, just do it. But you don't have to. So that was a large education process with a lot of clients to get them comfortable. We'd always really use total return swaps to get them comfortable with repo. And it is an operationally different and far more intensive act. Now that's on the manager and the custodian, not the client. But there was a lot of time spent with clients to say, we really need to add this to our toolkit because, there's times where the ultra contract, the ultra long bond contract, which is pretty magical for pension funds, it's way out the yield curve. It can trade 100 more expensive to a repo or 100 basis points more expensive to a TRS. So for our clients that use really any degree of a hedge in scale, we've really pushed them, and we have that flexibility to move between the instruments, and we move quite frequently between the instruments because there are times when that ultra actually trades relatively inexpensive, not in a long time, but.
Yeah, I would also very much echo kind of the operational and the infrastructure considerations. So it is far easier to set up a futures agreement or a cleared swaps agreement with one or two or three FCMs, and then you have the ability to trade with a wide variety of counterparties, where you have that one FCM that's clearing it. The margin is standardized. It's largely, again, it's cash for variation margin. To do OTC derivative trading, now you are setting up individual agreements with an array of dealers. right? So you have to negotiate those. You're going through credit. You also now with the unclear margin rules, you may have to set up initial margin documentation, specific custodial accounts for all that. So if you are already not in a position to do that for other reasons, that's a large hurdle to get over. So that can also contribute to why you may have a preference to using one product or one product set versus another.
I think I agree with everything my colleagues said. I think one other point I would add is that if you just look at the notional amounts, so I think in your chart you had about 900 billion in derivatives. Then when you look in the futures, and then when you look at the notional held by asset managers in cash treasuries. So again, based upon the SIFMA, all the data using the same definition as CFTC, you get to a number that is between 9 and 10 trillion on the cash treasuries held. So when you say, the futures give or take 7-8% relative to the cash treasuries held. Now, when I do our analysis and say that if all the frictional costs of futures versus repo were removed, how much would that change our futures position relative to increasing our cash treasury and repo was readily available? That number comes out to be somewhere around 15 to 20%. So we would still have, 75, call it, percent in futures. That would be for ease of execution, liquidity, and I think that's how we would think as the differential of frictions versus other factors.
Context, good context. Okay, also for the group, let's think ahead a little bit. So we're in an environment where the supply of Treasury securities has grown, and some of the estimates say that it'll continue to grow. As portfolio managers, how does the market adapt to this, especially when you're thinking about derivatives? So, do you see futures increasing or swaps or other instruments? Does the basis widen or get smaller? How does this impact your portfolio trading as you look ahead?
Yeah, I would say, the weights in indices will likely continue to rise, and I would expect that this trade will continue to grow in size. And also, as we've seen more inflows and more extension out the curve, you're going to see, I think, the trade grow in size as well. So, at least for the foreseeable future, I think that's kind of the trend.
So, Joe, you and I at breakfast were having a good discussion about collateral and margin and other things. You should have been there. It was good. But we'll
It's exciting stuff.
We'll follow up here. And actually, David Eichhorn, you had mentioned the gilt market volatility, and I think it all ties in together. So I guess the simplest question is, a number of commenters observed gilt market volatility. It involved pensions, LDIs, derivatives, something. They saw volatility and they thought that's bad. Do we have to worry about it here? What's the situation?
So I think from our perspective, when we came out of the financial crisis, right, the emphasis was on derivative counterparty credit risk. How do we reduce it, right? That was the primary objective, and that's been largely successful, right? So a lot of the derivatives moved to central clearing, and also we implemented the unclear margin rules. So increasingly, derivatives have more margin requirements. They have initial margin requirements. And you can see this in the ISDA data. The amount of collateral that's being exchanged across the street has been steadily increasing, again, to mitigate a lot of those counterparty credit risk concerns. I think the flip side of what that creates, and I allude this into the costs, is you have more margin needs potentially. And if you're talking about something that's margined in cash, then you need to either hold more cash on your balance sheet, which is going to create more mismatch. It may also create as far as a drag on your returns, or you need to start having more reliance on repo lines. So when we saw the UK gilt crisis and what happened, I think part of the dynamic there was kind of as far as gilt rates were rising, and they had to liquidate those securities to fund their margin needs associated with their derivatives, they got into that loop. So I think as we go now, and we've certainly addressed a large part of those counterparty credit risk issues, but we do need to be mindful of maybe some of the liquidity risk issues that come about of having ever increasing margin requirements in the derivatives markets.
Yeah, I certainly agree. And I think you can never say anything's fully addressed because markets humble us every day, right? But I do think the counterparty risk has been addressed. Curiously, an anecdote I'll share with my colleague Stephen, who's here. One of the last times NISA was at one of these events, it was in 2006 or 7, and that was convened by the Federal Reserve to, I forget the exact name, but the Committee on Counterparty Credit Risk. Ironically, that was in the auditorium at Bear Stearns. So hopefully my participation here doesn't portend anything awful. But on the UK side specifically, and this is not going to be a moment of American exceptionalism at all, I really mean that, there are some major structural differences in the US market and treasury market versus the gilt market, but also maybe I'll focus more on the LDI side of it. The UK liabilities are much longer in duration for a host of reasons, and they tend to be inflation linked, which makes them longer and a little more squirrely in certain ways, technical terms. So the US market is shorter in duration and nominal in nature. And we have the great benefit of having a much deeper set of instruments to get duration that aren't the D word. So corporate bonds, mortgages, et cetera. So there's just less of a need to add DV01 to hedge the liability. There's still a need to my opening comments, but it's much smaller in context and wildly smaller compared to the size of the US Treasury market, compared to the size of the UK gilt market. And then importantly, and this comes back, and there are a couple great comments by my colleagues, there's a variety of reasons to use different instruments. One reason we don't rely as much on futures, or not singularly on futures, and this is what happened in the UK, was they are cash margined every day. Importantly, even before the financial crisis, when we were a large derivative manager, we collateralized all our swaps in a bilateral way, not centrally cleared. But we've continued that, and obviously now in most cases it's mandated depending on the instrument. But importantly, a lot of our instruments, whether they be total return swaps or repos, we can collateralize by posting a security, a US Treasury security. So the UK instance started with a pretty bizarre fiscal decision. I won't handicap whether or not the US could ever make such a bizarre fiscal decision. That was the first 50 basis points, let's say, of the rate sell-off. The rest was the doom loop, largely caused by the need to sell the collateral to meet the margin, but you desperately needed that duration, and there's your doom loop started. I think in the US, there's such, at least at NISA, there's such a heavy reliance on physical posting to where we'd be able to post securities, not selling them to start the doom loop. Again, I'll never say never about markets, but I would say the US LDI market is just so much further out of the money on those sorts of risks, pretty ridiculously out of the money as we calculate it.
Yeah, I think David is absolutely right. Like the duration of the U.S. pensions and the instruments that they have, it's a better match versus for UK. The pension liability duration is much higher, so they needed to get to that much higher kind of leverage. And then the second part is the size of the pensions in the US is much smaller relative to the size of the treasury market versus in UK the size of the pensions relative to the gilt market. Right? If you look at the private corporate pensions, give or take 2 trillion something, call it 50% held in bonds versus equities, give or take, versus the size of the treasury market at 25 or so trillion. So that magnitude makes a huge difference in addition to the liability duration difference.
But it's still a cautionary tale, though, in a way, particularly in the U.S., where increasingly funds are less liquid, right? And so we might not have the same kind of doom loop that was well described, but this move towards illiquid assets puts pressure on the ecosystem if in fact that does occur, right? Because you don't have the postable collateral, you don't have the things that you can readily sell, and that could create a whole different dynamic. So that's what I worry about, the UK-ish type of LDI crisis here.
So again, to the group, you brought up some of the collateral and margin issues, and on the horizon, we have potentially more clearing of treasury securities, clearing of repo. So if we go out a year or so, thinking about, how much concern over margin or margin changes or those sorts of things impact your portfolio or not for the choices, and more of these portfolios being cleared, how do your answers change, if at all, in terms of how how the next couple of years play out?
I feel like I've already spoken a lot. I think one main comment I would say is, and maybe I shouldn't admit this, I'm at this conference, but some of the plumbing, there's far more experts at my shop than I am. But I think importantly, when you're using anything that allows cross-collateralization and cross-margining is critically important to us, because notwithstanding how I described our relative use of repo and total return swaps, the more of those there are times, even for pensions, where we need to short out some exposure on one part of the curve and be long on the other part of the curve. So the ability to cross-collateralize, cross-margin, my answer is kind of, it depends, depending on how it's done. Could be frustrating for kind of our client usage. If it's done well and permits that would certainly be an unequivocal positive for us.
I would just know one thing about the nature of fiscal stimulus now is that whether it's pro-cyclical or structural deficits, in a recession, you're going to have that demand for the safe asset. And one of the reasons why you've had more intermediation on the hedge fund side of things is because we have been running a lot of treasury issuance, a lot of supply at a time when managers are comfortable owning credit. So that plays a role. And I think I'm also no expert in the plumbing issues, but to the extent that any new changes disrupt that intermediation capacity, that's an important factor to consider.
Okay, I believe we'll have a few minutes if people have questions. So we'll open it up a bit to the audience if we can for Q&A.
You guys did a great job. And I don't say that just to help organize it, but this is fantastic. You didn't talk as much about the trend increasing. So it seems likely, like if supply increases, that these trends will increase. And I guess I wondered, would the basis then continue to widen? And how do you think about that? Do you have some internal cutoff point at which, well, this is now too high, it's too expensive, and I will begin to shift my strategies? How would you see that if those trends did continue? First, do you think the basis would widen? And if it did widen, how would you see yourself kind of responding over time in a general way?
I think it's a multi-factor kind of equation, right? So, as I kind of described before, there's lots of different components. There's where spreads are, where the basis is. But at some point, if the basis becomes, uninvestable vis-a-vis the opportunity set, then that'll push investors into treasuries. But we're not there yet. And so it's hard just to point to one factor and one number. It's not X. It depends on kind of, what's the opportunity set around you. But at some point, just given the unrelenting supply that inevitably we're facing, my strong suspicion is that there'll be an incentive to buy cash treasuries, which isn't a great outcome, by the way, but that's kind of how I see it from my end.
Well, I think that's the key. I mean, you hit a really key point that hasn't been discussed yet is really the fiscal situation and the fiscal profligacy of the U.S. government is, we can talk about whether it be hedge funds, and we're not a hedge fund. But what hedge funds are doing or asset managers, but at the end of the day, the basis, particularly I'm focusing on the back end of the curve, is tracking things like swap spreads, which to me is a real measure of a liquidity premium. And lo and behold, when you keep issuing bonds at the pace we are, there's a liquidity premium creeping in. So that creates the cheapness of the physicals, and somebody better step in to short. Far be it from me to say, hedge funds are great, but there has to be, and we do some of those trades. We have cash where instead of owning cash, we just do the basis trade unlevered, and it's a great way to pull that out. So I think that's a critical driver of why the basis is where it is. And obviously no one on this stage can address the supply. I know that much.
Yeah, so for us, I mean, the core reason why we're using a lot of these products that have duration, right, is we have these very long liabilities, and a lot of the spread product is shorter, and that creates a mismatch, right? So if treasuries are a greater percentage of the index, that doesn't affect that equation for myself, right? But for if you're benchmarked against the ag, and now a greater and greater proportion of that index is becoming treasuries, and some of that's going to be out the longer end of the curve, you have that similar dynamic, right? And a potential for more of a duration need, whether you do it in cash or you do it through the replications. I think the TBAC did a really good part of the analysis was looking at what are the costs of using futures over time and comparing that to spreads, right? So that's probably ultimately the limiter, right? Where it can get to if people perceive that this is costing more than I can earn on the spread assets, then it doesn't make sense. And I think the other piece of this from a cost perspective is basis volatility, right? So if you take this on, you're taking on a different risk that you have in your portfolio. So to the extent that you start seeing more volatility in the basis, that's effectively a cost, right? And that could also drive people away from doing the basis trade.
I would add, and just echo Greg's points on the multi-factor aspect of it. If we go into a recession, you're going to see bond flows accelerate, and you're going to see a preference for safe assets. Even if we have additional treasury issuance, it's entirely possible that that demand comes through from the money manager community, and you don't see the basis move. And it really does depend on the relative valuation. March of 2020 was a good example where treasury futures basis blew out, off the run spreads blew out, but high quality spreads blew out everywhere. And so it still made sense to hold on to those assets on a relative basis. So it really is a dynamic problem.
Yeah, I was going to say the same. Basically, the valuation in isolation of the basis, but then also in relative to other areas, right? So, and other sources of funding as well. So all of that will go into the determination of usage of futures versus cash for active managers.
Ira Jersey, Bloomberg Intelligence. Thanks very much for the panel. I'm going to sit down now so I don't block the poopy behind me. So you mentioned just now very briefly about swap spreads and kind of liquidity preference. How over the last decade have your portfolio shifted with the LIBOR transition to SOFR and with swap spreads so negative? How should investors and other users think about that relative value and how those other instruments besides futures can be used to generate leverage?
The easy answer for us, we were probably, Ira, great question. We were probably 90% interest rate swaps, back in the old days. We effectively use them zero now. So wild transition for a host of reasons. A big one though is the introduction of the ultra long bond. We couldn't really get the right yield curve in a lot of spots. So, but then a lot of the other measures we've talked about, and importantly, a build out on our end, we couldn't do repo or effectively 10 plus years ago. Now we do it kind of day in, day out, and we just had to build that out.
One factor for us is base curve. So, even though it might make sense, it's still preferable for us to stick to treasury base curve with futures, which is the index effectively compared to swap. So that's a major consideration, whether or not you want to take on swap spread basis risk or futures basis risk.
Yeah, I think same, like swap spreads have tightened quite significantly, look reasonably rich. So certainly not a reason, at least for us, to kind of have a long exposure through swaps, preference for usage of treasury and then needed usage of futures. So again, in that relative context, at the margin supportive for usage of future relative to swaps, given where swap spreads are.
So perhaps we could do one more if anyone has one.
Oh, hi. I guess I'm the last one. Is this on? Yeah. So Josh Younger from here, the New York Fed. And I guess my question's on this credit overweight, which seems to be the thing that everything turns around among asset managers, because that pensions and insurance companies would produce liabilities that are different from what the credit markets produce for high-grade corporations is not surprising. But to some extent, it seems like if enough asset managers are overweight front-end credit, that should be self-correcting. And yet it's persistent for many years. And without that, it seems like there's a lot less need for long futures, a lot less need for basis, a lot more need for matching the index more precisely. And so, I hear yield enhancement, but when everyone does yield enhancement, there shouldn't be more yield enhancement. So, but why is this happening? I guess is sort of my question, very open-ended.
I think there's this desperate need for income and return and performance. So I think it's as simple as that. I don't think it's this nebulous kind of story. Investors, invest with funds such as, us in various different forms to achieve a certain objective. And that objective function is to generate income and return. And, having that additional spread in a portfolio managed in a thoughtful way is additive to that end buyer. So that's how it is today. I think it's also important to state that there's not been a credit cycle in over 20 years, so time will tell, but we've been in a very benign environment for credit. There's this perception that central banks are there at the ready to kind of help out in times of need, so to speak, rightly or wrongly. It's been the right call by and large. So, that could change, but something has to change fundamentally. So it's a response to the underlying environment, nothing more than that, in my humble opinion.
No, I think it's part of the competitive landscape, right? As far as by introducing spread assets into portfolio asset allocations, you can offer more attractive pricing as far as to clients, rather than just having a treasuries only asset allocation against that portfolio. Life insurers are very well positioned to be holders of corporate credit. We're long-term in nature, that's our perspective, and we want to diversify that portfolio. So when you look at the spread markets, not every corporate issuer is issuing 20 or 30-year bonds, right? We want to diversify issuers across everything, and a lot of that will involve doing things either in the loan market, which from an interest rate perspective is essentially zero, or things more in the 5-year or the 10-year part of the curve. So again, for us to achieve that diversification, a lot of times you're buying things shorter dated.
Maybe one last point, provocative one. I know where I'm sitting right now, but I think the rapid intervention by the Federal Reserve at times is certainly very warranted, but undoubtedly it's a huge moral hazard. And the simple fact is, I think a lot of investors and managers feel I'll be okay because I'll be bailed out by being overweight a lot of spready product. And I think that's something policy groups need to think about hard and long about.
I would also reiterate something we spoke about earlier, which is this benchmark composition. So if the treasury weight goes from 20 to 45, and you're an active manager, and so you're always looking at your active portfolio and optimizing your active risk versus your benchmark, and you're saying, okay, look, I can't take too much tracking error. I want to deliver a strong information ratio versus my benchmark. I think as the benchmark compositions change, there's also a little bit of a rethinking on, do you want to just look at it that way? Do you just want to look at your alpha only, or do you want to try to provide a more diversified portfolio and take on more tracking error structurally? So I think that's another part of the conversation as the benchmark has evolved.
And just one quick thing from my side, in addition to what my colleague said, I think if you look at the last 12 years, 13 years since GFC, what you have observed from flow, from flow of funds with respect to what kind of strategies the funds have gone into, they've gone from more, call it, ag or higher duration oriented strategies into more credit oriented strategies. So while in isolation you can say that there is that little bit of, call it, credit, front end credit, in aggregate, in many ways, I would say the market has less duration exposure than what it had pre-GFC from an aggregate kind of flow data based upon the last 15-year data. So in an environment where there is any kind of economic activity decline or shock, I think you would see more flow into kind of the interest rate sensitive or interest rate oriented strategies, and that again would be supportive for the demand for treasuries.
Okay, well, at the outset, I promised you an outstanding set of panelists, and I think they definitely delivered. It's been a fantastic conversation with a number of things to think about beyond this. But if you would join me in thanking them, I think we're done.
Thanks, Scott, for running that panel extremely well, and thank you to all of our panelists for your interesting and even provocative comments. We appreciate that. At this time, we are going to do our first audience poll question. So I and waiting for a QR code or Slido code. So now it's audience challenge time to, on their device, go to slido.com and you can use that password number or the QR code. And we're going to go into our first poll question. So as hopefully most of you are aware, the most recent IAWG staff report was published within the last week. So we would like to ask a question related to that. So looks like people are figuring it out. All right, it seems like results are still coming in, but it seems like we have a clear winner with central clearing proposal appearing to have more votes than the other 4 categories combined. So I'm sure one of our afternoon speakers will be very happy to see that. Well, I'll let you keep on voting, but we'll push on to our next speaker. So I'd like to introduce Michael Barr, Vice Chair for Supervision at the Federal Reserve Board of Governors, who will be providing keynote remarks. Mr. Barr took office as the Vice Chair of Supervision of the Board of Governors of the Federal Reserve System in July 2022. He also serves as a member of the Board of Governors in the Federal Open Market Committee. Prior to his appointment to the board, Mr. Barr was the Dean of the Ford School of Public Policy and the founder and faculty director of the University of Michigan Center of Finance, Law, and Policy. Mr. Barr served as the U.S. Department of Treasury's Assistant Secretary for Financial Institutions from 2009 to 2010. He also served at Treasury in the Clinton administration. And we will reserve some time for Q&A after the remarks. So please join me in welcoming Vice Chair Barr.
Thank you, Brett, and thank you all for the opportunity to speak with you today. It's great to be here again, particularly because this year marks, as you've heard before, the 10th annual conference on the Treasury market, a milestone that is worth celebrating. I want to acknowledge the Federal Reserve Bank of New York for its leadership in this area, including the dedication and excellence it has brought to hosting this conference over the past decade, in collaboration with the Interagency Working Group on Treasury Market Surveillance, led by the Treasury Department. The Treasury market is the means by which our government meets its financing needs in service of the American people, and it is also a bedrock of the financial system. Promoting the resilience of the Treasury market and ensuring it can continue to fill these roles requires the collaboration of agencies and individuals across the government, along with the private sector. As others have pointed out today, we have made important progress since last year's conference. The Securities and Exchange Commission has finalized a rule on central clearing of Treasury securities. The Treasury Department has initiated a program for buying back less liquid Treasury securities. And the Office of Financial Research is preparing for its permanent collection of data on non-centrally cleared bilateral repurchase agreements, which will support our understanding of this market as it evolves. I will share some thoughts with you on how I see the work of the Federal Reserve in supporting Treasury market resilience. Our capital and liquidity regulations, our supervision of the firms over which we have authority, and our liquidity facilities play important roles in supporting market resilience and financial stability. Earlier this month, I gave a speech where I reiterated the crucial role of capital in serving these objectives and the need to balance resilience and efficiency in designing our rules. In that speech, I also outlined the elements of a capital reproposal that I believe will have broad consensus at the Federal Reserve Board. The adjustments are in response to a robust public comment process, and some of them are designed to address interactions, and market functioning concerns raised by commentators. In terms of rulemaking, today I will focus on some additional aspects of our regulatory framework, namely enhancements to our liquidity regulations. I will share some perspectives on how our liquidity regulations work together and are supportive of market functioning and the smooth implementation of monetary policy. We consider how all of the Fed's tools work together to support our objectives. In previous speeches, I've talked about the role of the discount window and the standing repo facility in supporting both monetary policy implementation and financial stability, noting how important it is that eligible institutions be ready to use those facilities. Today, I want to dig deeper into this topic, including how these tools support monetary policy implementation through appropriate incorporation into liquidity regulations and supervisory practices. After the banking stress in March 2023, we saw substantial improvement among banks of all sizes in their level of readiness to tap the discount window, both in taking the necessary steps for setup and in their pledging of collateral. Since that time, over $1 trillion in additional collateral has been pledged to the discount window, and additional banks have established access to the SRF. Both of these facilities are potential venues for monetizing assets and raising liquidity to address volatility in private funding markets or gaps in the availability of private market funding. We had been hearing that some were confused about how banks could incorporate ready access to the discount window and the SRF into their contingency funding plans and internal liquidity stress tests. Supervisors have a role in assessing the viability of large banks' plans to meet stressed outflows in their stress scenarios. And we have been asked whether the discount window, the SRF, and also Federal Home Loan Bank advances can play roles in these scenarios. The answer to this question is yes. We provided clarity to the public in August on permissible assumptions for how firms can incorporate the discount window and the SRF into their internal liquidity stress test scenarios. There are a couple of principles that underlie our response in the frequently asked questions we posted on the board's website. One principle is that our tools are readily available to firms. This means that we see it as acceptable and beneficial for firms to incorporate our facilities to meet liquidity needs in both planning and in practice. If firms plan to use our facilities, we expect them to demonstrate ex ante that they are fully capable of doing so, including through test transactions. An additional principle underlying our approach is that while firms should be ready to use a range of funding sources, firms need to hold sufficiently highly liquid assets to meet their potential liquidity needs. That is, they need to self-insure against their own liquidity risks. A third principle is that firms should be ready and able to use private channels to turn those assets into cash, in addition to any public channels they may plan to use. I want to dig a bit deeper into the benefits to both individual firms and the financial system when firms incorporate Fed facilities into their stress preparedness planning. Again, a design feature of our liquidity regulations is that large banks must self-insure against major liquidity risks. Our regulations also provide flexibility in terms of the portfolio composition such banks use to do so. This flexibility allows them to adjust their portfolios based on market conditions and firm needs. A key component of this flexibility is that reserves and certain high-quality liquid assets, such as Treasury securities, are equivalent in terms of being treated as the highest quality of liquid assets. This feature is important because while it allows firms to manage their liquidity buffers more flexibly, it also allows for greater flexibility in our monetary policy implementation, and it supports market functioning. We have heard over the years, however, that the degree of substitutability among these assets has been limited in part by concerns about capacity and stress for the market to turn securities into reserves immediately. These concerns are valid. This constraint can be addressed in part by the appropriate incorporation of Federal Reserve facilities into monetization plans and as firms' internal liquidity stress tests. When firms understand that they will not be fully constrained by the capacity of private markets or their individual credit lines to monetize high-quality liquid assets immediately in stress, they can reduce their demand for reserves in favor of Treasury securities, all else being equal, for their stress planning purposes. This dynamic improves the substitutability of holding reserves and holding Treasury securities, either outright or through repo transactions. When banks exhibit a high degree of substitutability of demand for these assets, money market functioning improves. Let me explain with an example. If a bank sees holding reserves and investing in Treasury repo as near substitutes in its liquidity portfolio, it should lend into Treasury repo markets when repo rates rise above the interest rate earned on reserves. When banks can nimbly adjust portfolios in response to price incentives, the efficacy of reserves redistribution through the system improves and market functioning is enhanced. In aggregate, this activity can prevent rates from rising further, all else being equal. The point at which banks in the aggregate have a relatively immutable demand for reserves and are unwilling to lend them out is evidence of when a small decrease in the supply of reserves results in a sharp increase in the cost to borrow them. Our monetary policy tools are well positioned to help us avoid such an outcome. But of course, greater willingness of banks to reallocate across close substitutes should help avoid the emergence of sudden pressures in money markets by reducing money market frictions. In 2021, the Federal Reserve launched the SRF, which along with the discount window should help cap upward pressure in repo markets that could spill over into the federal funds market. Use of these facilities also increases the supply of reserves in the system. The enhanced clarity for firms that Fed facilities are a fully acceptable venue to get same-day liquidity for their HQLA should help reassure firms about holding reserves and their close substitutes, such as Treasury securities, in their liquidity portfolios. Of course, as I stated earlier, for the largest banks, there is a requirement that they hold high-quality liquid assets to address their own liquidity risks. They must also be ready to use private markets to monetize these assets. It is also critical that banks recognize and manage their interest rate and liquidity risk of their securities portfolios to ensure that those securities held for liquidity purposes can be monetized in a stress without creating other adverse effects on a firm's safety and soundness. In 2022 and 2023, certain large banks did not effectively manage the risks of rising rates and suffered significant fair value losses on their securities holdings, including those in their held to maturity or HTM portfolios. These losses affected their ability to respond to liquidity stress, as monetizing the assets could result in realizing losses. When the banking stress hit in March 2023, those securities could not be sold to meet stressed outflows because large unrealized losses inhibited their sale without significant capital implications. This is further complicated in the case of held-to-maturity securities, which cannot be sold without risking a revaluation of a firm's entire HTM portfolio. Selling HTM securities to generate liquidity would therefore have had a particularly large effect on these firms' capital levels, likely increasing the stress on these firms. Further, some firms were unable to rely on private channels, such as repo markets, for monetization because they were not prepared, they were not regular participants in the market, and market participants were unwilling to lend because of counterparty credit concerns. This combination of factors meant that HTM securities that had been identified for banks as available to serve as a liquidity buffer in stress could not effectively serve that function. As I've mentioned before, to address the issues that we learned about liquidity in the spring of 2023, we are exploring targeted adjustments to our current liquidity framework. Many firms have taken steps to improve their liquidity resilience, and the regulatory adjustments we are considering would ensure that large banks maintain better liquidity risk management going forward. Improvements to our liquidity regulations will also complement the other elements of our supervisory and regulatory regime by improving banks' ability to respond to funding shocks. Specifically, we are exploring a requirement that larger banks maintain a minimum amount of readily available liquidity with a pool of reserves and pre-positioned collateral at the discount window based on a fraction of their uninsured deposits. Community banks would not be covered, and we would take a tiered approach to the requirements. The collateral pre-positioned at the window could include both Treasury securities and the full range of assets eligible for pledging at the discount window. It is vital that uninsured depositors have confidence that their funds will be readily available for withdrawal if needed, and this confidence would be enhanced by a requirement that larger banks have readily available liquidity to meet requests for withdrawal of these deposits. This requirement would be a complement to existing liquidity requirements, such as those in the internal liquidity stress test that I described earlier, as well as meeting the liquidity coverage ratio. Incorporating the discount window into a readiness requirement would also re-emphasize that supervision and examination view use of the discount window as appropriate under both normal and stressed market conditions. In addition, as I've previously discussed, we identified significant gaps in interest rate risk management in the March 2023 banking stress, including in portfolios of highly liquid securities. Relatedly, we saw that banks face constraints in monetizing HTM assets with large unrealized losses in private markets because they were unable to repo these securities or sell these securities without realizing significant losses. To address these gaps, we are considering a partial limit on the extent of reliance on HTM assets in larger banks' liquidity buffers, such as those held under the LCR and ILST requirements. These adjustments would address the known challenges of banks being able to use these assets in stressed conditions. Finally, we are reviewing the treatment of a handful of types of deposits in the current liquidity framework. Observed behavior of different depositor types during times of stress suggests the need to recalibrate deposit outflow assumptions in our rules for certain types of depositors. We are also revisiting the scope of application of our current liquidity framework for large banks. These enhancements to our liquidity regulations will help bolster firms' ability to manage liquidity shocks, and they also be well integrated into our monetary policy tools and framework. Turning back to the discount window, I also want to note that the discount window has served its role well in recent years, and that we are engaging in ongoing work to improve its operations. Given the crucial role of the discount window in providing ready access to liquidity in a wide variety of market conditions, we continuously work to assess and to improve its functionality while engaging with current and potential users of the window. Among the steps we have taken recently include that we have now an online portal, Discount Window Direct, that allows firms to request and to prepay discount window loans in a more streamlined manner than was previously possible. We also recently published a request for information on discount window operations and daylight credit, asking about key components of these facilities. Feedback from the public will help us prioritize areas for improvement. So I strongly encourage anyone with an interest in this topic, which I gather would be most of you in this room, to weigh in during the comment period. Your feedback will help us to ensure that the discount window continues to improve in its role providing ready access to funding under a variety of market conditions. Thank you very much, and I look forward to your questions.
Jim Tabaki, Independent Dealer Association. Mr. Vice Chairman, I appreciated all of your comments about the discount window and the standing repo facility. The question I have is, there are many participants in the Treasury market, has intermediaries that are independent dealers that are neither primary dealers or banks. And opening up these facilities to a part of the market that is, by our measure, 15 to 20% of the intermediaries that play in that market would go a long way. You can't eliminate 15 to 20% of the intermediaries and really cover liquidity risk in a spiking situation. What are your thoughts there?
Well, thank you. As you know, under the Federal Reserve Act, absent unusual and exigent circumstances, we're limited in the counterparties that we can have in our standing facilities. And so those facilities are available essentially to banks.
Yeah. Hi, Cheryl King from the Bank of Canada. My question would be around efforts to mitigate the stigma of the discount window. It's often argued that the FHLB is a preferred source of funding for liquidity needs because of the implications of accessing the discount window is that you are in a crisis. Do you feel like these efforts that you're trying to put forward are going to eliminate the stigma, or is it going to mitigate the stigma?
Thanks. It's a great question. I mean, the problem of stigma and the discount window has been a long-standing one. Really, since shortly after the creation of the discount window, there have been concerns that using it might be seen as a sign of weakness. And one of the messages that I've been trying to convey in speeches I've given over the last couple of years is that we don't view it that way. We view use of the discount window as a fully acceptable, normal part of any bank's funding needs. If it makes sense for them to use it from a financial perspective, if it makes sense for them to use it because of gaps in private market sources, if it makes sense for them to use it for contingency planning, we want banks to use the discount window. So a part of what we're doing is messaging that we believe that the discount window should be used by banks when it makes sense for them to use it. And many of the other kinds of steps that I've described are designed to sort of put our money where our mouth is on that.
Priya Mishra from JP Morgan Asset Management. Question, Vice Chair Barr, on the supplementary leverage ratio. Any thoughts there if, as the treasury market grows in size, if that is a limiting constraint for balance sheet of dealers? Is that something that the Fed is thinking about?
The question is, how are we thinking about the composition of our balance sheet?
Or how you're thinking about the recalibration potentially of the supplementary leverage ratio?
I'm sorry, my hearing has gotten a little bad, so I'm not sure I caught the end of the sentence. So,
the SLR.
Oh, I'm sorry. Thank you. We have been and are looking at all of our capital rules, including the ESLR, to think about how they relate to Treasury market functioning. That's an area that we'll continue to explore. We don't have any current plans with respect to the ESLR at this time.
It's okay. I had the same question.
Thank you, Vice Chair Barr. Mark Cabana from Bank of America Securities. With regarding your comments around partial limitation for large bank HTM, how do you envision that will be calculated or calibrated? And when do you expect that the public can learn more detail through a potential more formal proposal along these lines?
We're looking at the appropriate calibration. It's at this time we haven't made a firm decision about what the right level is. We're looking at the experience of the last couple of years. We're looking at practices that larger banks currently use, and I expect that we'll have a proposal either later this year or early next year for people to look at and be able to dig into the substance in more detail. We'd of course put it out as a proposal for public comment and get feedback from the public and affected institutions. So I look forward to getting that feedback as part of our process. I think I've exhausted you. Thank you very much.
Thank you for those remarks and those good questions. We're going to take a break now. We'll reconvene the conference in about 20 minutes at 11:15.